Welcome to The Explainer. Today, we've got a really fascinating look into the machinery of a company that is right in the middle of a massive strategic evolution. We're pointing our focus at Gentrack Group Limited and their freshly released interim financial numbers for the first half of 2026. If you're someone who tracks how critical global infrastructure is modernizing, this is an explainer you absolutely do not want to miss. We're going to break down exactly how Gentrack is navigating some pretty complex markets, how they're deploying their cash, and how they're shifting their revenue models, all based straight on the objective data from their financial reports.
All right, let's dive into this. Here is our roadmap for today. We'll start with the H1 2026 financial overview, then look at the utilities sector performance, followed by the Veovo airport sector growth, then we'll unpack their strategic acquisitions, and finally wrap it all up with a summary and disclaimer. Section 1. H1 2026 Financial Overview, the macro view.
So to really grasp a company's trajectory, you gotta look at the big picture first before zooming into the specific divisions. The first number to lock in your mind is $110.1 million. That's Gentrack's total group revenue for the first half of 2026. Now, context is literally everything here. This figure is actually down just a hair from the $112 million they reported back in H1 2025. On the surface, a dip in total revenue might make you raise an eyebrow. But as we're about to see, the actual makeup of that revenue tells a much more dynamic story of a company in transition.
And that brings us straight to the next huge metric, $85.3 million. This is Gentrack's group recurring revenue. If you know software, you know this is the holy grail growth metric. For Gentrack, this number is up a very healthy 12% over the prior period. So what this shows us is that the foundational, ultra-reliable revenue base of the business is expanding solidly, even while total top-line revenue shrank just a tiny bit. Backing all of this up is a fortress of a balance sheet, featuring a cash position of $73.2 million. And the kicker here, Gentrack operates with zero debt. Having over $70 million in cash reserves with literally no debt gives management a ton of strategic agility. It means they're incredibly well capitalized to weather any industry hiccups, fund their own internal R&D, or, as we're going to see in a minute, go out and aggressively target some key acquisitions. Now here's where the push and pull dynamic of Gentrack's financials gets really interesting. That overall revenue dip we just talked about, it's actually a deliberate strategic shift. Look at this contrast. We've got a 12% jump in highly desirable recurring revenue, directly offsetting a massive 30% drop in non-recurring project revenue, which fell down to $24.9 million. This is basically textbook for a tech company moving deeper into a SaaS as a service model. They are clearly prioritizing sticky, long-term, predictable contracts over one-and-done implementations. Section 2. Utilities sector performance. Steady core amidst delays.
Transitioning over to what is effectively a tale of two very different sectors, let's start with their utilities division, which handles their energy and water software. Looking at the revenue breakdown, we see the exact same dynamic playing out that we noticed at the group level. Utilities recurring revenue grew by 9%, hitting $73.3 million. But the non-recurring revenue took a pretty big hit, falling down to $17 million. According to management, this drop came down to two things. First, a bunch of projects successfully went live right around the end of the last financial year, meaning that revenue was already out of the pipeline. And second, there were some unexpected delays in closing new customer deals. Keep in mind, these are massive 10 to 20-year enterprise commitments we're talking about, so the sales cycles are naturally long and the timing can be pretty lumpy.
Because of that drop in project revenue, earnings definitely felt a pinch. EBITDA, excluding acquisition costs, landed at $7.9 million, which is down from $13 million in the prior period. But if you read the source material, it's clear this wasn't just a matter of lost revenue. It was a conscious choice. Management decided to keep investing heavily in product development and international growth, especially over in Asia and Europe, rather than just slashing costs to artificially pump up short-term earnings while they waited for the pipeline to close.
Section 3. Veovo airport sector growth. An exceptional half.
Now let's flip the script and look at Gentrack's other main engine, the Veovo airport software division. While utilities had some timing bumps, Veovo had an absolutely blockbuster half. Management literally called it exceptional, and looking at these drivers, you can totally see why. Total revenue came in at $19.8 million. Now sure, that might look like just a modest 3% bump, but that completely hides the real performance, because the previous period included a massive chunk of low-margin hardware sales. If you strip that hardware out, Veovo actually grew an impressive 20%.
And the real headline is a staggering 33% step up in recurring revenues, hitting $12 million. This surge was driven by some huge new wins, like locking in Nav Canada right at the start of the half, plus successful software upgrades for clients they brought on previously.
Section 4. Strategic Acquisitions Unpacked. Deploying cash for growth. So we've got a utilities sector investing through a lull, and an airport sector firing on absolutely all cylinders. But remember that $73 million in cash? Gentrack isn't just letting it gather dust. They are aggressively deploying it for growth. In May 2026, so keep in mind these won't even hit the financials until the second half of the year, they announced 2 major bolt-on acquisitions, perfectly aligned with their 2 business units. For the utilities sector, they picked up a company called Factor, bringing in specialist forecasting and pricing tech for the B2B energy market. And over on the Veovo side, they bought DTP, or Dubai Technology Partners. This is a huge move. It brings in the Airport View app, AI-enabled operations, and gives them a massive footprint in the Middle East, which happens to be one of the hottest global markets for airport investment right now.
And this brilliantly illustrates a massive theme highlighted by management: the incredibly rapid adoption of artificial intelligence. I mean, think about it. Energy companies, water grids, major international airports, they are all under insane pressure to modernize and actually prove they have a working AI strategy. For Gentrack, management sees this as a huge tailwind. Because they already hold decades of operational data and have incredibly deep domain expertise in these environments, they believe they are in the exact right position to help their clients automate, price dynamically, and actually build that AI-driven future.
Section 5. Summary and Disclaimer. Wrapping up H1 2026.
Okay, let's wrap this up and lock in the big takeaways for Gentrack's H1 2026. Total revenue sat at $110.1 million, revealing a very deliberate structural shift toward a more predictable recurring revenue model. The utilities division posted 9% recurring growth, even with project delays dragging down short-term EBITDA. Meanwhile, the Veovo airport sector completely crushed it with a 33% surge in recurring revenue. And finally, the company took that rock-solid, debt-free $73.2 million cash pile and used it to snap up 2 highly strategic AI-focused companies in May.
Before we finish up, a quick but absolutely crucial legal note. This explainer is strictly for informational and educational purposes. We are simply providing an objective breakdown of Gentrack's publicly available financial reports and management commentary. This is not investment advice, it's not financial guidance, and it is definitely not a recommendation to buy or sell securities. Always make sure to do your own research and consult with a licensed financial advisor before making any investment decisions. All right, that brings us back to you. We've laid out the data, the sector dynamics, the whole shebang, straight from the source. Now I'd love to hear your analytical takeaways. How are you interpreting Gentrack's balancing act here? Taking a slight dip in total revenue while aggressively pivoting toward those sticky recurring contracts? And what's your read on their strategy to deploy cash into AI-centric acquisitions like Factor and DTP? Drop your thoughts down in the comment section below. Thanks so much for joining us for this explainer, and as always, keep learning.